Namaste everyone and welcome back. Your go-to place for understanding tricky tax stuff in simple language. Let's start. Ever wondered why one shopkeeper's accounts look completely different from the shop next door, even if they do the same business? Or why sometimes even simple accounts seem a bit messy? Let's take a moment here. For years, businesses that aren't registered as formal companies. Your local kirana store run by a sole proprietor, a family business like a Hindu undivided family or HUF partnership firms. Even many societies and trusts didn't have a single standard way to prepare their financial statements. Everyone did it their own way, or maybe followed formats needed just for tax filing. Now, think about this. While companies follow strict rules from the Companies Act, non corporate entities had more flexibility. But flexibility can sometimes lead to confusion, right? It became hard to compare one business to another, or even track the same business year after year properly. So, our own Institute of Chartered Accountants of India, or ICAI, decided to bring some order. They've come out with a guidance note that provides a standard format for financial statements of these non corporate entities. Here's a quick point. Who does this apply to? Anyone doing business or professional activity who isn't a company or a limited liability partnership, LLP, unless a specific law already tells them exactly how to format their accounts. This includes sole proprietors, HUFs, partnership firms, whether registered or not, societies, trusts, private or public, registered or not, and pretty much any other organization doing business. You might have seen this happen in real life. Accounts looking very different. Why this change? The main goal is simple: to make financial reporting more standardized, more transparent, and easier to compare. This helps everyone involved: the owners, banks giving loans, tax authorities, and anyone else looking at the accounts to understand the true financial health of the business better. Okay? So, it's all about improving the reliability and usefulness of financial statements. Let's break this down. This new format and guidance note is effective from the financial year 2024 to 25. This means the financial statements you prepare for the year starting 1st April 2024 onwards will need to follow this new way. If you're preparing accounts from 1st April 2025 for the year ending 31st March 2025, you'll use this. Is it compulsory for everyone? Officially, the guidance note is recommended. However, if your business requires a tax audit under Section 44 or if you need finances from banks or other formal sources, following these formats becomes practically essential for getting your accounts signed off by a professional. Let's quickly recap. Standard format for non-companies from FY24 to 25. Simple enough, right? Now, let's talk about what's new in the format itself. Before, many non-corporate businesses used a T-shape or horizontal format for their balance sheet. The new guidance says you should use a vertical format, similar to how companies present theirs. Sounds familiar? If you've ever seen a company's balance sheet, you'll recognize this. Another big change: you must prepare comparative financial statements. This isn't just showing your numbers for the current year. You need to show the figures for the previous year right next to them. This makes it super easy to see how the business performed compared to last year. This applies to the balance sheet, the profit and loss statement, and even the notes that go with them. Okay? Showing the comparison is key. There are also some changes in terminology. Don't get scared. It's just new names for things you already know. For example, what we often call fixed assets are now generally referred to as property, plant and equipment, PPE, and intangible assets. Debtors are now called trade receivables. Creditors are now called trade payables. Your capital in the business is now part of owner's fund. Your sales are called revenue from operations. The P&L account is now the statement of profit and loss. Even simple things like rent might be part of lease expenses depending on the arrangement. Income tax is called tax expense. Same concepts, just updated names to align with more formal accounting practices. Let's look at the main parts of the financial statements in this new format. The balance sheet is divided into two main sections. 1. Owner's funds and liabilities. This includes the owner's capital or partner's capital and current accounts for a partnership. Any reserves or surplus funds, non-current liabilities, long-term loans, long-term provisions, etc., and current liabilities, short-term loans, trade payables, other short-term obligations. We need to separate things based on whether they are due or relate to a period within or beyond the business's operating cycle or 12 months, whichever is longer. 2. Assets. This includes non-current assets like your PPE, intangible assets, long-term investments, long-term loans given, and current assets. Investments that can be quickly converted to cash, inventory, or stock. trade receivables, cash and bank balances, and short-term loans given. Again, the current non-current classification is important. Okay? Just a structured way of presenting what the business owns and owes. Next, the statement of profit and loss. This shows your income and expenses to arrive at the profit or loss. It starts with revenue from operations and other income, giving you total income. Then you list out various expenses like cost of materials, employee costs, depreciation, finance costs, and other expenses. Here's something different. For partnership firms, partners' remuneration, like salary or commission to partners, is shown separately after calculating profit before such remuneration and tax. Interest on partners' capital, however, is generally part of finance costs. The statement then shows profit before tax, followed by tax expense, leading to the final profit or loss for the period. Besides the balance sheet and P&L, you might also need to prepare a cash flow statement. This statement is like a summary of all the cash coming into and going out of the business during the year. It categorizes cash flows into three main activities: operating activities from the main business, investing activities, buying or selling assets, investments, and financing activities, taking or repaying loans, owner's contributions or withdrawals. And very importantly, there are notes to accounts. These provide details about the items shown in the main statements. These notes are also now standardized and comparative. Let's quickly recap. Vertical format, comparative figures, updated names, clear structure for balance sheet and P&L, cash flow may be needed, and detailed notes. Now, some specific points to remember when preparing these. Rounding off is not mandatory for non-corporate entities, but it's allowed. If you do round off figures, there are guidelines based on your total income. You are generally not allowed to offset assets against liabilities or income against expenses unless an accounting standard specifically permits it. Important information needs to be disclosed in the notes. For example, contingent liabilities, potential future obligations depending on something happening, must be disclosed unless the chance of them happening is very low. Details about related party transactions also need to be disclosed. Here's a quick point. When detailing expenses in the notes, if any single expense item is significant, specifically if it exceeds 1% of your revenue from operations or 1 lakh rupees, whichever amount is higher, you must show it separately. You can't just hide it in other expenses. This is something most people get wrong when not following a standard format. For trade payables, the notes might require breaking down amounts owed, potentially including showing separately amounts due to micro and small enterprises, MSMEs, as per relevant laws. Let's take a moment here. Remember the cash and bank balances line item? The notes clarify how to classify certain bank deposits. If a fixed deposit has an original maturity of 3 months or less, it's generally considered a cash equivalent. If the original maturity is more than 3 months but less than 12, it might still be a current asset but shown separately, perhaps under other bank balances. This follows the definition from Accounting Standard 3. For provisions, like a provision for income tax, you show the amount net of any advance tax paid. The notes for assets like property, plant and equipment, PPE, are very detailed, showing the opening balance, any additions, deletions, depreciation for the year, and the closing balance. All these detailed notes help provide a complete picture. Okay? These guidelines draw upon various accounting standards issued by the ICAI, ensuring that even non-corporate entities apply core accounting principles correctly, such as the accrual basis of accounting, proper inventory valuation, cost, or net realizable value, whichever is lower, correct revenue recognition based on transfer of risks and rewards, recognizing provisions for known liabilities, and proper treatment of capital and revenue expenditure. These new formats and guidelines also help you avoid many common mistakes observed in the past. Things like not giving enough detail about your accounting policies, recording income or expenses only when cash is received or paid, ignoring the accrual basis, wrongly valuing your inventory, recognizing revenue too early or too late, not creating provisions for expenses you know are coming, mixing up capital and revenue expenditure, not charging depreciation or using wrong methods, not disclosing contingent liabilities, making errors in foreign currency transactions, not showing prior period items separately, not capitalizing borrowing costs related to assets being built, not separating current and non-current items properly, wrongly valuing investments, changing accounting policies without explaining why, ignoring the correct treatment of government grants, mixing personal and business expenses, a very common one, not properly spreading expenses that benefit multiple years, deferred revenue expenditure, wrongly recording trade discounts, not reporting events after the balance sheet date that are important, All these mistakes can compromise the reliability of your financial statements. Let's quickly recap. New detailed requirements help avoid common errors and follow accounting standards better. Adopting these new formats comes with compliance requirements. You need to adhere to accounting standards, prepare statements in the prescribed formats, provide mandatory disclosures, ensure proper auditor oversight if applicable, ensure professionals have adequate training and awareness, and maintain proper documentation. Okay, it's a bit of work, but it's worth it. Because what happens if you don't comply? You could face regulatory penalties, damage your reputation, get audit qualifications, which is like a red flag on your accounts, potentially face litigation, and lose the trust of banks, investors, and others. This new guidance note is a significant step towards improving financial reporting in India, especially for the vast number of non corporate businesses. It makes financial statements clearer, more trustworthy, and easier for everyone to understand and use for better decision making. In summary, from FY 2024 to 25, non corporate entities need to prepare their financial statements using a new standardized vertical format, showing comparative figures from the previous year using updated terminology, and providing detailed notes that comply with accounting standards and specific disclosure requirements, including separating significant expenses. It might seem like a big change, but it's ultimately for the better, bringing more structure and credibility to the accounts of millions of businesses. Okay, now you know what most people don't. This is important stuff for anyone running a business or handling accounts. Share this with someone who needs to know. Maybe your accountant, a business owner friend, or someone starting out. If it's still confusing, listen to this part again or drop a comment, and we'll try to help you understand it better. Thank you for watching, and see you in the next video.